All right, we'll start. Welcome. We've got people joining thick and fast. That's great to see. Welcome, everyone. While we are waiting for everyone to join, if you can just pop in the chat where you're joining us from, that would be great. We love to see where people are joining from. London. We've got Angie from London, Tyler, Austria, Tim in Florida. Tim, the weather must be warming up quite nicely. Josephine in Bermuda. It's always fantastic there. Alison from the UK. Gwendolyn from Cork. Mary from San Diego. Logan from Texas. Welcome, everyone. Suzanne from Massachusetts. So great to have everyone join us today. Hi, Kira. I hope I'm saying that properly. From Dublin. Bob P. Hi, Robert. Hi, Bob. Joining from the Lake District of England, Janina from Germany. Hi. It's always so exciting to see everybody joining from around the world, regardless of the time. We'll just give it a few minutes and see where others are joining from. Welcome, everyone. Finland. I think this is probably the first time that I've been on that we've had somebody from Finland. Fantastic. Phil from Germany, Lenny in Lisbon, Tanvir from Finland, Miguel from Spain. Nice. Welcome, everyone. Welcome. Lynn in Paris. Rebecca's in Canada. Great. Fantastic. Morgan in Norway. Welcome. Welcome, everyone. It's really great. I mean, regardless of the time zone, everybody always just joins from Casablanca. JP, hi. Welcome. That's really, really great. Okay, so welcome, everyone. Um, Thank you so much for joining us today. Just to introduce myself, my name's Deborah. I'm the head of customer success here at TFX. We're very excited to have you join us today as we dive into some common tax questions. We're also going to review some tax deadlines and look at how TFX can make tax filing easy and stress-free for you. I'm aware that some of you have filed with us before. That's really fantastic. If you're coming here with questions, that's really, really great. So whether you are in the US or whether you are an expat and you're outside of the US, we're going to help you navigate your tax season with confidence. We assist everyone, all US taxpayers who are in the US or abroad. So, just to refresh your memory, in case it's been a while, TFX is a top rated tax service. We're trusted by over 50,000 clients worldwide, and our team consists of 80 plus experienced CPAs and EAs, many with over 20 years experience handling both US and expat tax returns. We specialize in optimizing your tax filings, ensuring you get the maximum credits and deductions possible while making the process stress-free and absolutely smooth. So today we have a special session lined up. Our expert CPA, exceptionally qualified specialist, Andrew Coleman, will be answering your tax questions. Andrew has 15 years of experience working with expats. He really knows his stuff. He knows for sure how to deal with taxes and to ensure you receive the maximum tax benefits possible. After that, he'll be taking your live questions. So please, as soon as those questions start opening up, please feel free to start submitting them. Our incredibly skilled and experienced CPAs, Reed and David, are also in the chat throughout the session. They'll be assisting you in real time. Additionally, we have Dev, one of our customer support experts. She is here to address any questions you have about our processes. We'll make sure to follow up on all questions we've received in advance, so we'll be sending you an email after this, as well as any of your unanswered questions from the session. But stay tuned, please, because that's not all. We'll also share some special promotions just designed to help you save on tax preparation with TFX. So, Andrew, I'm going to hand over to you.
Great. Thank you, Deborah. I appreciate the introduction. Hello, everyone. Nice to see all of you in the chat room saying where you're from. It's really neat to see all the places. Yeah, like so Deborah said, what I'm going to do is spend just a few minutes going through few slides just to give some reminders about filing obligations and some tax deadlines. So yeah, what we'll do is, here's an agenda, and I'll just talk about the general filing requirements, and then I'll talk about the deadlines and how taxes for expats can help. And then we'll get to our Q&A. So yeah, so let's get into it. So the general filing requirements, many of you are already, I'm sure that you're aware, there are filing requirements to file a tax return. On this slide, it talks about what are the thresholds for filing, the minimum income thresholds. So you can see, and this is for 2024, you can see for single, it's 14,600. Head of household, it's 21,900. And when you're married filing jointly, it's 29,200. And then when you take notice of the married filing separately is only $5. So that is not a typo. That is a real thing. So a lot of you, maybe you're familiar with that or not, but if you're married filing separately with a non-resident alien spouse and NRA, you kind of have to be mindful of this low filing threshold of $5. So these are the general requirements. There's can be other requirements that require you to file a tax return. For example, if you have more than $400 in self-employment income, then you need to technically file a U.S. tax return. And self-employment income can be anything from, just if you receive a 1099 living abroad, but you receive a 1099 from a U.S. company, or you're just working on your own and receiving money from, if you're living abroad and you receive money from another foreign country, that's not employment income. And yeah, that's self-employment income. So it's something to think about on filing thresholds. There's also other reasons to file a tax return, and that's to get credits. And that can be like sometimes a refund, sometimes a carry forward of a credit. Talking about, just continuing with this path of filing obligations. When you do have to file, there are benefits for people living outside the US, and maybe most of you are aware, there's the potential to use when you think about your earned income, either through employment or self-employment, you can use the foreign earned income exclusion or the foreign tax credit system. So those are some benefits that are given to expats when you live abroad. So there's also treaty claims that you can make on your tax return. Most countries, not all, but most countries have an income tax treaty in place to mitigate double taxation on the same income. So a lot of times those are in place in the country that you live. It depends on the type of income, and it also depends on, if you're a U.S. citizen, there can be a lot of those benefits that might not be available due to what's known as a savings clause. But we will take care of all of that. As you know, we'll take care of that when on your tax return. So when we're filing the tax return, we'll do all the reading through the tax treaty to make sure that when we prepare your tax return, you're getting all these benefits, and if need be, any tax treaty claims on certain types of income. And then there's always these acronyms to think about are FATCA and FBAR. And the FATCA and FBAR are, I think on the next slide, it talks about what is the FBAR reporting requirements. Well, yeah, so it's general requirement to file an FBAR, and we'll handle that for you if you'd like for us. We have a very good system in place to do this. So basically, it's required when you have more than $10,000 in a non-US account. And that figure, that 10,000, is across all of your accounts, not just one account. So you think about your regular deposit account, securities accounts, pension accounts, all these non-US accounts, all those things that I just said, your deposit, your securities accounts, and pension accounts. You pick the highest balance from each one of those accounts, and then you aggregate that. Is it more than 10,000? And so that's what, if it is, then you need to file an FBAR. And so, yeah, that's the FBAR, the Foreign Bank Account Report. And then there's also the FATCA reporting. FATCA reporting, it's similar in nature to the FBAR. It's filed, though, this FATCA reporting requirements, it's filed with the tax return. The FBAR is filed separately from the tax return. The FBAR is filed with the US Treasury Department, and we'll take care of that. The FATCA reporting requirements, it's this Form 8938. It's filed with your tax return. But the idea of it is similar to the FBAR, that you need to report your non-US accounts on this form. And there are different thresholds than the FBAR. So if you're living in the US, and for example, this slide says single or married filing separately, it's over, if you have over 50,000 as of December 31st, or over 75,000 at any time during the year. And then you can see it's a little bit higher, basically doubled the thresholds if you're married filing jointly. So yeah, this is something for you to be aware of when you're filling out the questionnaire. You know, you'll see this in your engagement letter, and we'll take care of all that for you, making sure that if you've exceeded those thresholds, that that you're filing the right forms. But these are just things you should be cognizant of, these thresholds. And then the next slide just talks about living outside the US. Again, these thresholds are different than the ones when you're living in the US. So if you're living outside the US and you're single or married filing separately, you'll see on here it's over 200,000 as of December 31st, or over 300,000 at any time during the year. And then when you're married filing jointly, the thresholds double. So yeah, over 400,000 on December 31st and over 600,000 at any time during the year. So yeah, those are just the general reporting requirements for your foreign. And when I say foreign, it means non-US. So non-US bank accounts, securities accounts, and retirement accounts. And also, this slide is something that if you're not familiar with, this term Streamlined Procedure, there is a program in place. If you have not ever filed a tax return, or if you filed and you have missing income or missing forms, the Streamlined Procedure is meant for like an amnesty program to get you back in compliance with the IRS. And basically what this Streamlined Procedure, it covers 3 years of tax returns, 6 years of FBARs, And you also need to include a personal story, like a certification letter. So you're basically telling the IRS what happened. Why didn't you file a tax return, or why are you amending a tax return? So yeah, this is kind of like a personal story that goes along with this streamlined procedure. So the streamlined procedure is you have to be eligible for it. So there's within that 3-year period, you need to have at least 1 year where you've been outside the US for at least 330 days. So there is like an objective test, but then there's also the other part of it is that you need to be non-willful in a sense that you didn't know or you weren't aware. And so if this does apply to you, we can surely help you out. We help a lot of US citizens or green card holders with this program. So it's a really good program, and it's meant to essentially help reduce any penalties down to zero for late FBARs and late tax returns and and basically there are penalties on other forms, like if you own a business, like a limited company outside the US. That streamlined procedure is a really important because there's a lot of penalties on certain international forms. So it's a great program to get you catch you up on your US tax filings. And yeah, so we can talk about filing deadlines real quick here. There is, and on the next slide, it'll show what are the overall deadlines. So April 15th is the tax deadline for US-based taxpayers, and June 15th, this year it falls on, the 15th falls on a weekend, so it's June 16th. It's the expat tax deadline. And what that means is when you're living outside the US on April 15th, the IRS gives you a 2-month automatic extension. So basically, expats get that automatic 2-month extension to June 16th this year. If you think that you won't be able to file your 2024 tax return up until June 16th, make sure you request an extension in your account, in your TFX account, so that you get that filed, and there's a QR code that you can go to. It's really easy to do. We'll take care of it for you. And there's no downside. So just make sure you always, even if your tax return is in progress, it's always best to just have it filed. And yeah.
Okay, thank you very much,
Yeah.
Andrew. I think we've got a few questions that are coming through,
Okay.
and David and Reed have been answering some. I think David and Reed, if you want to push some questions to Andrew, I know I've got a few questions that came through in the registration. One of them being, why use foreign credit versus income exclusion?
Okay. So yeah, great question. So just thinking about that, why use so is the question, Deborah, about the difference between those two?
Yes, the person's just asking why use foreign credit versus income exclusion. So it's probably
Okay.
drawing the comparison between the two.
Yeah, so basically, the foreign earned income exclusion is, and so think about your earned income. If you have a salary, you need to report your income, whether it's from the US or from outside the US. Your worldwide income needs to be reported, your earned income. And when you think about the two main benefits of making sure you're not double taxed on income is the foreign earned income exclusion, which is Form 2555. And the two ways you can use that are you're either a bona fide resident of a foreign country where you live, or you're physically present outside the US for 330 days during a 12-month window. So that's a really good, you basically, the way that form works is you declare your income, we prepare that form, and then we exclude it. So if, for example, let's say $70,000 is your earned income, you report that on the 1040, and then on the foreign earned income exclusion, it reduces by 70,000 and to your earned income showing 0. That's just a basic example. There's differences sometimes if you have US source income or worked in the US, or but the idea of that foreign earned income exclusion is relatively straightforward. Like I said, that physical presence test is a lot of times when you first move abroad, you use that. And then once you've been living in a foreign country where you're paying taxes, or you're basically becoming a permanent resident there, or you intend to live there, there's like a bunch of facts and circumstances tests, but you can become a bona fide resident, and that it gives you a little bit more freedom with your US visits. So you can, when you're a bona fide resident and using the bona fide residence test on the foreign earned income exclusion, you can come and go more easily to the US than the physical presence test. So that's one factor. The other system is the foreign tax credit system, and that's basically a little bit different from the foreign earned income exclusion. The foreign tax credit system really is a good system in place because it allows you, if you're thinking about your salary, so instead of excluding your income for the foreign earned income exclusion, the foreign tax credit system basically works that your foreign taxes will help to offset your US tax on that earned income. And if you've paid a lot of foreign taxes in that foreign jurisdiction where you live, you get to carry forward that excess credit 10 years on your tax return. And that is a really good benefit, a benefit that you do not get on the foreign earned income exclusion. So there's a really, if you don't owe taxes and you have the choice, generally it is nice to have that foreign tax credit carry forward if you have a lot of foreign taxes paid. So there's other reasons to use the foreign tax credit system. IRA contributions could be a factor when you need to have earned income, showing more earned income on your tax return. So there's definitely benefits to both of them. We will help you assess that in the tax return process. If you need to, if you're thinking about which one do I use, we will just take care of that analysis for you. What makes sense in your situation? Yeah. So yeah, great question, Deborah. I'm looking at the Q&A. I can go ahead and get started on the Q&A here.
Sure, because there are lots of questions coming in. So go ahead.
Great. So Victoria, if you file, Victoria's question, if you file an extension, does your obligation for FATCA and FBAR automatically get extended as well? Great question. The FBAR is automatically extended until October 15th. So there's nothing that you would need to do to extend the FBAR. The IRS just automatically allows you and gives you until October 15th. The FATCA form, what I mentioned before, the 8938, that is part of your personal tax return on the 1040. And that FATCA form is not automatically extended to October 15th. FATCA, when we say FATCA, it's this form 8938 that's filed with the 1040. So it does, the FATCA is part of the 1040. So if you're an expat, you do get a 2-month automatic extension until June 15th to file that form, that FATCA form 8938. But beyond June 16th, you need to have an extension in place till October 15th, because you don't want to file that FATCA form late, because there are there are penalties involved with that form if you're filing that late, your tax return late. The next question, anonymous, are accounts for which I have signature authority but no financial interest included in the thresholds for FATCA and FBAR? Ooh, great question. So the FBAR includes the signature authority accounts, so it is part of your that threshold. But the FATCA is not reporting signature authority accounts. So that form 8938, it is similar to the FBAR, but it's not the same. And this is one of the great question to point out. The FATCA threshold does not include signature authority accounts. So you don't need to worry about signature authority, like the highest balances in signature authorities, for the purposes of FATCA or 8938. So the next question, are foreign pension distributions considered general income or passive income? Ooh, great question. So yeah, so if you think about anybody out there who's what this is talking about is basically using the foreign tax credit system. And when you're thinking about the foreign tax credit, this form 1116 is filed with your 1040. And so there's a general category and there's passive category. So in terms of general income and passive income, I think that's what the question is about, which bucket or which basket does a foreign pension distribution fall under. And this really is, I would say it is, I've seen it both ways, honestly. In the tax returns that I've come across, the general rule is foreign pension distributions. And if we're talking about, if you think about your foreign pension distributions, non-Social Security accounts outside the US, so you receive a foreign pension distribution, and probably there's some foreign tax credit. You've paid some income taxes in the foreign jurisdiction, or it's been withheld on the foreign distribution. Basically, it is general income. And so if you think about your general foreign tax credit, you can utilize your foreign income taxes in the general basket. There are cases where Social Security can be considered passive or general, but generally speaking, when you think about your income taxes that you've paid or had withheld on the foreign pension distribution, whether it goes on the general income or passive income, it's the main thing is to report it, and then we'll take care of whether it's considered passive or it's considered general. Sometimes there are cases where it's a different type of category, like resourced by treaty. This is an interesting point. When you think about your form 1116, there's certain types of income, retirement income, that need to be classified in a different bucket on the foreign tax credit system. So in this question, the next question from Robert, in the UK, I can take 25% of UK pension without paying tax on it, 75 years old or younger, I believe. Will the IRS honor the 25% by also not taxing it? So basically, great question. So when you think about the UK, there there are benefits to having that. And so from the US tax point of view, it is included, it's considered. But a lot of times what our job is to make sure it's just because it's what you provide us, that pension distribution might not be for US taxable income. It might not be the exact amount that you receive. And for example, there's pension distributions are made up of employer contributions, employee contributions, and the growth. So the taxable portion of your UK distribution, pension distribution, we'll analyze that to make sure not only is the 25% considered, but also what is the basis in that whole pension that you've accumulated over the years, and we'll make sure that you get any benefits in that UK pension distribution. So, and yeah, the analysis of that goes back to how much has your employer contributed, how much have you contributed, and then how much earnings has been in that retirement account. So Allison, let's see here. Next question is, if I cancel my green card, do I have to file? In the year that you give up your green card, you need to file a US tax return. So typically this, that you have to file in the year. So for example, Allison, if you gave up your green card in 2025, you basically will file a final 1040 for the year 2025. And basically you'll wait till the end of the year, so early 2026, after the 2025 year is over, we'll need to wait before we file your 2025 US tax return. And some kind of thinking about some details and the facts of this, when you have a green card, you have to pay attention also to how long you've had the green card. There's different rules for whether you're considered a long-term resident. 8 years is a kind of a cutoff for different types of filing obligations in that final year. So if you've had a green card for more than 8 years, kind of considered like what's called a long-term resident. Basically, the IRS wants you to file some additional form next to the 1040 and the 1040 NR that will take care of you, take care of that for you. But there's a form 8854, and this is filed when you give up the green card that you've held more than 8 years. It's a really important form. Yeah, so that's something we would take care of. But just to answer your question generally, you do need to file when you cancel your green card. After you cancel your green card in 2026, in the 2026 tax year, if you don't have any US source income, you don't need to file a US tax return. So if you do have an asset in the US or like an IRA or 401k and you receive a distribution and you've given up your green card, you would still need to file a US tax return. It's just a different form, a 1040 NR. So that's after the year after you give up your green card. Yeah, so next question, let's see here. Anonymous, can I start this year for my 2025 return? I've moved back to the US from the UK and I have complicated personal tax, 3520 filing. I can then upload US income, W-2s, and ACA tax. Happy to pay for your tax prep in advance and upload everything this year. I also wanted to ask you if you deal with aspects of US citizen tax now that I'm back stateside. So if I understand this question in the beginning, can I start this year for my 2025 tax return? just to clarify, when and for those of you who aren't familiar with, maybe you are familiar, if you're in the UK, there's a fiscal year difference between the US and the UK. I wasn't sure all the details here, but basically the 2025 tax return will be filed in early, we can start filing that in early 2026. If you meant the 2024 US tax return, you can start that now. Absolutely. Yeah, so we'll take care of all that. You upload all your information, all your W-2s, 1099s, any non-US income, because we have to report your worldwide income, not just your US income when you're living in the US. So yeah, I think what kind of the open question of whether 2025 or maybe this person meant 2024, but we can get started if you meant 2024. So yeah, the next question is, Kayleen, what is the best way to receive an inheritance? For example, when a parent passes, they will part of their money. So this question is an interesting question. What is the best way to receive an inheritance? For example, when a parent passes. Well, there's things to think about. First of all, is your parent a non-US person or not? And that matters because, you think about your inheritance. When you receive an inheritance from a non-US parent, so your parent is in my example, a non-US citizen, a non-US green card holder, there's a really important form that needs to be filed when you inherit more than $100,000 US, and it's form 3520. And this is not to say that you owe taxes on that inheritance. It's basically it's a compliance form, and it's an important part of your tax return, and we'll take care of it when we prepare your return. But there's a lot yeah. So an inheritance in this case, in my example, you receive an inheritance from a non-US parent, and it's more than 100,000, you have to file this form 3520. It doesn't mean that you pay taxes on that when you receive the inheritance. If, for example, you inherit a house, for example, and it's from a non-US parent, and it's more than 100,000, if you were to sell that house or asset or stock, whatever, there's certain things you have to consider when you sell that inherited asset. So that's a really important part of our work, is analyzing what is your basis in that inherited asset. So if we're talking non-cash assets, so stocks or real estate. So that's an important part of analyzing your capital gain or capital loss on that asset when you sell it. So receiving an inheritance doesn't immediately require you to pay taxes on that inheritance. It's more about the compliance when you receive an inheritance, and also when you sell that, if it's an asset. Ooh, great question. Next one, risks of quiet filing. So this individual is asking, so this individual seems to be familiar with quiet filing. Quiet filing is a process where you don't use an amnesty program. You don't use, like what I mentioned before, a streamlined procedure is this amnesty program. Let's just say this quiet filing is really just filing the 3 years of tax returns that have not been filed under no program. And it's basically just filing late tax returns. That is one way to get in compliance with your US taxes. quiet filing really does, in a sense, if you haven't filed, it really brings out risks for, penalties. If you choose the quiet filing path, it means that you are subject to penalties on if you owe taxes, for example. If you owe $1,000 of tax liability on a tax return, you have interest, and then you'll have penalties on that $1,000 of tax liability. And the quiet filing, you will have penalties on that late filed tax return, late filed payment. But with Streamlined, for example, if you compare to Streamlined, it takes away those penalties on that late filed return and late payment. Only leaves the interest. You still have to pay interest on the Streamlined procedure. So in a quiet filing, when you owe taxes or you have international forms that are part of your 1040, like the FATCA form 8938, the form 3520, form 5471, form 8621, which is like a PFIC filing. Maybe somebody will ask about that later. It's really important to use the Streamlined procedure or use some sort of amnesty program, and we'll advise you on all that. The quiet filing, it's not advisable if you can avoid it because of the risk of penalties involved. So next one, Angie, I have a UK pension. The UK allows for a drawdown 25% lump sum without having to pay tax. I understand that the USC deems this lump sum as a taxable income. Is this correct? It is correct. Yeah, so in terms of yeah, you'll have to declare, you think about your US tax return, just generally, broadly, all your worldwide income is taxable. Whether you pay taxes on the tax return itself, it remains to be seen after we combine all your income and all your foreign tax credits on your tax return. But in general, that lump sum distribution that you receive in the UK, it's taxable income on the US tax return. And then whether you owe US taxes, what percentage should I set aside? Really, it does depend on do you have existing foreign tax credits in your general category or passive category? Do you have losses offsetting that income? So really, to answer that question, it really requires you for us to put together your tax return, get an idea of where we're at, get a draft of the tax return, including that UK pension distribution. And then we'll see, do you owe taxes or do you not? So that's really the only way to determine, and if you're thinking, for example, this is a future transaction, 2025 or 2026, and you're wanting to set aside now, I can tell you that we offer a service called a tax projection service. If it's a big chunk of money, like 100,000, 50,000 or 200,000 you're receiving, and you don't know the impact, what I would highly recommend is a tax projection. When you go to our website, there's a list of all these services that we offer for our clients. And under the services, there's a tax projection service. And that projection service basically is an estimate. We compile an estimated, if the transaction, a pension distribution is later in 2025, we'll put all your estimated income together on your 1040 and look at that and say, hey, here's a estimated tax liability with that lump sum distribution, some earned income. Here's your estimated US tax liability. You want to pay this in installments, estimated tax payments throughout from June to December. So that tax projection service is really helpful if it's a substantial amount of distribution. Let's see, the next one, Benjamin, hypothetical scenario number 2. What if the capital gains are from a U.S. company and gains and dividends were realized in the U.S. stock market, but when sold, transferred back to Germany happens? Do I have to pay taxes again? Do those gains take advantage of the foreign earned income credit? Ooh, good question. So capital gains, so both taxed in Germany at vest or wartime, and gains and dividends. So yeah, so it's a great question, Benjamin. When you have a stock compensation that has vested, we say that that is ordinary income. So if you think about your salary, your allowances, your benefits, and your vesting of stock compensation or share-based compensation. So if it vests, it's considered part of your ordinary income and you're paying taxes locally. So if you think about that as earned income, part of your compensation package, and that is part of the foreign earned income exclusion. And you can use the foreign earned income exclusion for that ordinary portion of that stock compensation, that vested income. And so you think about, yeah, your question mentioned the foreign earned income credit, but I think you meant foreign earned income exclusion. There's also the foreign tax credit, and you can either use either or for this type of earned income. When you sell those shares, so if it's vested, and then now you've take ownership of those shares, so you physically have the shares, and you sell, and let's say you don't sell right away, you wait 6 months and you sell it in December. There's a spread, there's some fluctuation in the market from the date that from the value at vesting to the date that you sell. There's a capital gain. That's passive income, so that's something we'll take care of on the tax return. But there's a portion that's if you pay taxes on that capital gain in Germany, on that any gain between the vesting date and the sell date, then you can offset with foreign tax credits on the passive category. So but we have to make sure we get that calculated all right, and kind of bifurcating the ordinary portion versus the capital gain portion. So dividends are also passive in nature. So whatever income you're thinking about, yeah, so we'll make sure and take care of that for you when it relates to stock compensation. Holly, I apologize if this question has been asked before. We have moved back to the US, but my husband still has a pension remaining at a former employer in Canada. He is under retirement age, but we are nervous about leaving our funds there for too long with regards to exchange rates, international financial condition. Can you advise us as to tax implications of the US or Canada to move these funds over to our accounts in the US, and what type of professional we should look for to help us account for those funds being moved? Great question. So yeah, if you're thinking about really an important part, really important question, pension. So it's either 2 ways to get your money out of the foreign pension is a distribution, early distribution. And as we all know, generally taxable on your US tax return. And if you pay any Canadian income taxes on that pension distribution, you'll get a credit on your US tax return for that pension distribution. Or there's options of rollovers. So rollovers into another Canadian pension account. So the tax treaty, each country has their own very specific rules about what's allowed for, and Canada has a complicated income tax treaty, and it talks about rollovers. So these are an important part of our work to analyze all that and look at what is a rollover from a Canadian account to another Canadian account, is that taxable or not? There's been some guidance from the IRS in the past, and they provide a lot of guidance as to specific to Canada, what is allowed or what is taxable and what is not taxable in a rollover. So there can be situations where when you do a rollover in Canada, where it's not taxable, but there are situations where it is taxable. If you're wanting to get the money out of Canada into like a retirement account, you will have to pay, if you think about your, like I said before, the overall concept, a distribution out of a foreign pension account is US taxable income. And then I also go back to what I mentioned before is what is the taxable portion? So we'll analyze what is the amount that's taxable for the US. And we think about your husband's contributions, his personal contributions into the pension, and employer contributions. So yeah, there's a lot of factors to consider, but a really important question there. Anonymous, I have a US S Corp, a consultant practice. I work in Ireland with a critical skills visa. I am paid a base salary paid by my US company through an employee of record. I also get per diems. The per diems go to my US company. We all sell online training licenses. Those fees go to my company. Does that sound okay? I pay taxes in Ireland through the EOR. My company pays taxes to the US. Does that sound about right? Yeah, so basically, interesting question. I work, so it is common to have when you're an expat and you have an S Corp in the US. I've prepared a lot of tax returns in these situations, and I've also reviewed a lot of tax returns. So we prepare 1040s, 1120Ss, and we deal with this all the time. There's a lot going into this type of question, a lot of complexity. What we're looking for out of an S Corp is either a W-2 or a K-1 that comes out of there. So if you think about as an expat living in Ireland, you think about, okay, I have certain income items from my S Corp. How does that affect my US tax return? Yeah, so with this type of question, there's like, the question is this sound right? I'd say we would need to get into the tax return when we do get into it. It's very okay to have an S Corp as an expat, completely fine. We just need to make sure that you don't you manage it right, and that you don't underpay in US taxes. You get the benefits of having an S Corp being abroad, making sure you get the benefits as an expat, like I said, the foreign earned income exclusion, or the foreign tax credit system if you're paying taxes in Ireland on that, like a K-1, if there's profit from the S Corp. So there's a lot of things to consider there, but we can definitely help out with that. Robert, what tax credits, et cetera, for only unearned income for retirees? Is unearned income treated the same as earned income? Yeah, again, for unearned income, passive income. So for example, interest, dividends, capital gains, rental. So any foreign rental profit, rental, or any foreign capital gains, foreign dividends, you're allowed, if you're paying foreign income taxes on that unearned income, that passive income, you are allowed a foreign tax credit on your US tax return for that unearned incomes, Robert. So yeah. So next question, Canadian living in the US, now US citizen, March 2025, any changes to be aware of? So yeah, so if March 2025, it's just thinking about you have a dual status tax return situation. So that's just the most important thing to think about. The year that you become a US citizen or a US resident, we need to file the right forms as a dual status person. So in the year that you become a US citizen, You need to deal with 2 U.S. tax returns as part of your U.S. tax filing. There's the 1040 NR for that period that you were not a U.S. citizen, and then there's the 1040 for that period where you are a U.S. citizen. And we'll take care of all that, bifurcating the income, the benefits, and it's complicated, but I would say just the most important part of thinking about it is having that dual status year in the year that you become a U.S. citizen. Are there multiple foreign tax credits for different revenue streams? I think we've discussed this. Yes, to that question. I see a comment here, a word, limited company, Angie. Limited company, this is something you need to be careful, be mindful of. When you own a limited company, maybe we haven't had a chance to talk about it too much, but for anybody out there with a foreign limited company, a very important form that you need to file is Form 5471. And if you don't file that, there's a big penalties involved with it. And it's really important if you own a limited company, a foreign limited company, and that you file this Form 5471. And if you have profit from it, what is unique about that limited company profit is that it is the IRS made it very difficult to utilize individual foreign tax credits on foreign limited company income or profit. So that is something to really look out for. Everything else on there, employment, self-employment, pension, shares, if you mean capital gains from shares, you can use foreign tax credits, but the limited company income, and maybe if you're familiar with a term called GILTI tax provision, this GILTI, it's a terrible, terrible acronym. I didn't come up with it, but the acronym is GILTI. The IRS established GILTI tax provision. And basically that is for when a US citizen owns more than 50% of a limited company, that profit needs to be on your 1040 as ordinary income. So it's a really important part, and you can't use the foreign earned income exclusion on that limited company income. It's a really important part. I've seen a tax return prepared by somebody themselves, like a 1040 self-prepared, either in TurboTax, and they had a 5471 filing requirement. They had a profit from a limited company, and they put that profit through the foreign earned income exclusion, and they messed up their tax return, and the IRS sent letters, and we had to amend the tax return. So we helped them out of that situation, but it's just really important on foreign limited company income that you definitely seek guidance on that. And we'll take care of all that for you, but it's more just be aware of that type of income. Anonymous, hi, this year I paid state taxes for the first year ever.
Sorry.
What other types of write-offs? Yes, Deborah.
Sorry, Andy, we're just running out of time, and there are so many great questions that have come through from people. Thank you very much, everyone, for submitting your questions. I know you wanted to get to one last question, Andy, but just before we run out of time altogether, we actually just wanted to remind everyone that there are ways for them to earn some credits from us. Andy gave you really great information today, especially about avoiding those dreaded IRS letters. But if you already have, and I'm sure most of you do, already have a TFX account, you can actually just log in, refer some of your friends and family so you can save, so you can get some credits. The more people you refer, the more you actually get some savings added to your account, which is really great. Sorry, the other thing we're also going to be doing is adding a $50 credit directly to your TFX account. So if you're logged in we will automatically activate this credit. You can just make a prepayment of $300 and we'll automatically increase that to 350. So there's no promo code required for that. We're going to automatically provide that for you. If you are brand new, I'm not sure that any of you are, you're welcome to sign up and you can contact our support team. We will assist you with absolutely anything, any questions that you have. For those of you who did not have your questions answered this evening or this morning, sorry, it's evening for me. But for those of you who have not had your questions answered, we will send you an email to answer those questions. So thank you again. Thank you so much for attending and thank you for submitting your questions. Have a great day. Thank you so much. Thank you, Andy. Thank you very much.
You're welcome. Thank you, everyone.
Bye.
Bye.